Let me just double check that. Check 1, 2. Okay, yeah, looks like we got sound. Okay, all right, so let's just go ahead and get into Chapter 5. Unless you guys just want to let me go ahead and let you finish talking, and I'll just sit down and relax. And when you're ready, just let me know. Okay? All right, good. So let me fix this light situation. Okay, all right, so we have really kind of completed this process now of preparing external financial reports. Okay, we learned about that in financial and intermediate. We've dealt with the now tracking the cost through in a manufacturing entity that goes from raw materials to work in process to finished goods to cost of goods sold if we were a manufacturer. Okay, now the focus of the course is really going to turn towards preparing data for internal use. Okay, so instead of looking at external financial reporting, we're going to say, well, how do we take the accounting information to make business decisions like how many units should we sell to break even? Should we even get into a particular product if it looks like it's going to be too difficult to break even? If we want to change our sales price, how will that affect our net income? These sort of things. These are all what? Internal decisions that are being made, and we're going to use the accounting data for that. Okay? We call this cost, volume, profit relationships. Now, when we look at these cost, volume, profit relationship, one of the key ones is going to be figuring out our break even. Okay? Now, what we're going to do is we're going to see that we're going to prepare our income statement now using what we call a contribution format. So we're going to prepare a contribution income statement, and in the contribution income statement, we go ahead and break our costs into those that are fixed versus those that are variable, right? And again, we've probably done some sort of analysis using regression analysis or using, what is this? Let me see. Guess we're going to be stuck with. Okay, so we're sitting there and we're doing what? We're doing an analysis using regression analysis or using high-low method or something to try and figure out which costs are fixed, which costs are variable, right? Once we do that, we can prepare a contribution margin format for our income statement in which we will say we have a contribution margin, which you can see is equal to sales minus our variable cost. Okay, now think about it. If we're producing product, can we produce product without incurring variable cost? We cannot. So there's nothing to sell unless we incur those variable costs. So when we take our sales minus our variable cost, contribution margin is looking at what's left after we've covered our variable cost. And then we take that contribution margin, you can see as I've written up here, we analyze it to see to what extent it first contributes to fixed cost and then contributes to what? Any profit. Because once we've covered our fixed cost, then we're profitable. Okay? So we have to cover our variable cost up front. Got to cover those. We're going to have a unit to sell. We've incurred the variable cost, and once we cover those, we have this contribution margin left over. Contribution margin first contributes to what? Fixed cost, and then to our net income. Okay? Now you take a look, and you can see here that we may want to know what our contribution margin per unit is, and it will be the sales price per unit minus the variable cost per unit. It is useful for us to know what our contribution margin per unit is because when we do our break-even analysis, we will often be saying how many units do we have to sell in order to break even. Now, obviously, if a problem, homework or something, test question doesn't tell you the sales price per unit, the variable cost per unit, then you could take what? The total contribution margin, divide that by the units, and that will obviously give you the contribution margin per unit, right? Okay, so you take a look, and the way we set up problems, and this is John talking now, this is what I'm telling you how to set up these problems. Anytime you get a break-even analysis is to set it up as your contribution margin per unit, which you may have to calculate in the problem, times your break-even sales in units. If we're trying to get our break-even in units, we set that up as the unknown, equals our fixed expenses, right? And so we'll know what our contribution margin per unit is because we know our sales price, we know our what? We know our variable costs, and then what? We take the difference between the sales price per unit, the contribution margin per unit, difference is variable cost per unit, difference is what? Contribution margin per unit. You set that times the unknown break-even sales in units, and it has to equal fixed expenses. Now, the reason I do that is I have a lot of students that want to start saying to me, okay, so I just need to memorize that, right? I just want to memorize that. I'm going to memorize what's in that box. And they start memorizing something without realizing what they're doing. You are setting this up to say, what is the what? Level of sales in units that will allow me to cover my fixed cost to break even, right? When you set it up like that, then you simply do the algebra, divide each side by the contribution margin per unit, and that will give you the unit sales to break even. Okay, so let's just go ahead and let's take a look at this example. And we've got this bike company, and its sales price per bike per unit is $500 per bike. Its variable cost per unit per bike is $300. So you take the 500 sales price minus the 300 cost per unit, and that is going to give me my contribution margin per unit here, which is what? $200 contribution margin per unit. Sales price minus variable cost gives me the contribution margin per unit. Now the problem told me that the fixed costs are this 80,000, right? Okay, so we just set that up the way I showed you, set every problem up the same. The $200 contribution margin per unit times the what? Whatever the break even in units are to cover, need to be to cover my fixed cost of 80,000. I do the algebra. I simply divide the contribution margin per unit into the fixed cost of 80,000, and that tells me that I have to produce 400 units if I want to break even. If I want to just cover my fixed cost, right? Now, if you wanted to turn that into an amount per into a dollar amount, I should say, you would take the what? The break-even units times the sales price per unit, and you can turn that into a dollar figure that way, right? We have to generate 200,000 in sales to break even. Okay. Now, when you look at this contribution format income statement, and we kind of are proving what we just figured out here a minute ago, notice that it sets things up so you can see what is my sales price, which is just like a regular income statement, but then we start taking off what? Variable costs, and they told us it was $300 per bike. If we're selling 400 bikes, that's 120,000. Gives me contribution margin of 80, and if my fixed costs are 80, did I break even? Okay. All right. So that's how you compute contribution break even in units. Okay, by using that contribution margin. Now you come over, and very simply, if we want to hit a certain target profit, we simply do what? Add target profit to our fixed costs. Remember, we said contribution margin first goes towards what? Fixed cost, and then our operating income. And so if you want to sit there and say, well, what's my target profit, or how many units do I have to sell to meet a certain target profit, you simply add the target profit to the fixed cost, right? Divide that by the contribution margin per unit, and that will give you your target profit units, right? How many units do I have to sell to meet a certain profit? So you come over and you look at this similar example, but now we've simply added what? $20,000 of target profit, so you add that to your fixed cost, divide that by the contribution margin per unit, and now we have to sell what? 500 bikes if we want to have what? This 200, this 20,000 left over. Okay, Now, when you look at the contribution format income statement, considering now this 500 bikes to meet this target profit of 20, sure enough, it works. Sales price, and it's just kind of proving what we just looked at. Sales price, 500 bikes times 500 each, that's 250, less the variable cost. 500 bikes times 300 per bike is 150. Contribution margin of 100,000. First goes to cover what? Fixed cost, and then profit operating income. Question? Okay, good. Let's look, and as I said, for this chapter, I'm still in the mode where I'm embedding the quiz questions into the slides themselves. So I'm doing that for chapter 5, and I think we cover all but 3 of the quiz questions in the slides themselves, and there might be a few more quiz questions that are in the slides, but I've combined them for the most part. Okay, so the break even in units sold, and the quiz is also a Word file, right? Also the Word file in Canvas. Okay, but I just pasted some of them in here. The break even in most of them. The break even in units sold will decrease if there is an increase in answer selling price. Now let's just work with that last set of numbers to see if that makes sense. Our selling price was what? 500, wasn't it? Okay, but let's say we increase it to 550. So we take this 550 minus the what? 300, that's variable cost. I don't know what VV is. Variable cost, okay, of 300. That leaves us a what? Contribution margin of 250 per unit. Okay, now what happens? Again, guys, I set these up the same way every time I'm trying to figure out what the break-even units are, what the target profit units are, just so I make sure that I know what I'm doing and I haven't, you know, sometimes if you memorize a formula, you think you're thinking your thoughts, but your thoughts are thinking you. The formula is pushing you, and you're like, well, wait a minute, is this really what I wanted to analyze? And you end up analyzing for the wrong thing. And make no mistake, they set up these multiple choice questions in these test banks and stuff so that they have answers that have pre-made your mistake. They've thought about the mistake you might make because you've memorized this, and then they put something up there that is not the same analysis or something, right? And you do the wrong analysis. So I always recommend that you set it up. It gets tedious sometimes, but just set it up. $250 per unit contribution margin per unit times what? Times my unknown here, break even in units, equals my fixed cost of 80,000. Do the algebra, and this problem tells me that if I want to break even, I have to sell 320 units. Well, a minute ago it was what? 400 units to break even, but that's when my sales price was what? Only 500. So if I increase the sales price, I can decrease the break even in units, right? Which is what the answer to this question was. So what's the big question from a business standpoint? What are these? None of you're all accounting majors, right? There's no marketing majors in here? What are those annoying marketing people gonna have to tell us? Well, they want to increase sales, right? But they come up with this 550 number. Can you sell whatever it is, 320 bikes at 550? We're just taking that number and assuming we can sell those, right? That's their job.
Yeah.
Okay, they're the ones that are on the hook to explain why they couldn't sell 320 bikes. We just told them that's how many they had to sell, right? Okay? Okay, good. Now you come over and you take a look at this one now, and it says Breeze Inc., a company that produces and sells a single product, has provided its contribution format income statement for April, blah, blah. The company sells 5,800 units. Its total contribution margin should be closest to, and what I just did here is I said, well, look, the problem already gave me the contribution margin, didn't it? So all I have to do is divide that by the number of units that were sold to generate that contribution margin, and I get the contribution margin per unit, right? Right? Just divide the contribution margin by the number of units. That gives me the contribution margin per unit. All these steps down here are for people that are, love to just write numbers down. I'm just go straight to here. I can get this same answer by taking this 52, well, not this answer, but right here, by taking the $9, by taking the 55.8 and dividing that by the 6,200 units. That's $9 per unit, right? Okay. Then once I have that $9 per unit, I just multiply it by the number of units the problem was calling out, and my contribution margin then should be 52 too, right? The answer to this question? Okay. Okay, good. Come over and let's take a look at this one, and now we have a question in which they want to know, well, same kind of question. What is the total contribution if you sell, 4,700 units? Okay, so we again take the contribution margin, divide it by the number of units, gives me the contribution margin per unit, times the number of units. The question is assuming here we have a contribution margin of 89.3. So what's that? 2 steps versus 4, doing it the way the solution showed. What's wrong with 4 steps? What's wrong with doing something in 4 steps when you can do it in 2? Time, what's worse than time though? 4 chances for a mistake there, right? Versus what? Versus 2? Okay. Okay, good. Come over and let's take a look at this question. Holtz produces and sells a single product. The selling price of the product is $230 per unit. Variable cost is $66.70 per unit. Fixed expenses are $212,290 per month. The break even in monthly sales is closest to, I take my sales price per unit, I subtract my variable cost per unit. That gives me contribution per margin per unit of what? 163.30. So here this problem was just giving me the per unit information, right? So I'm happy with that. That helps me. Then I set it up. Contribution margin per unit times whatever the break-even sales is, what this problem was looking for, has to equal my fixed cost. I put in my contribution margin per unit. I do the algebra. Answer is 1,300. Now, do you want to break even in life? Well, there's nothing wrong with it. I mean, if you spend your last penny on the day you die, some people may think you're a failure. Other people may think you're a success. If you have any kids, your kids will think you're a failure. Dad didn't leave us anything. This time. If you don't have any kids, who's going to be there to argue, right? Okay. All right. Of course, you know why you have kids, right? So there's someone to drive you to the old folks' home? Okay. All right, so what happens? You sit there. My dad told me that. Okay. So what happens? You sit here and there's what? 1,300 units, okay? Now you come over and that's the answer. What am I saying? That's it, 1,300. Let's look at this one. Where I was going with this is we want to make a profit, don't we? And so we have another break-even analysis. So much for my great timing, okay? So we have what? We have these sales price per unit of 40 minus the what? Variable expenses is 22. That's $18 contribution margin per unit. We set this up. Contribution margin per unit times the break-even sales equals fixed cost. Again, do the algebra, and it's what? 4,600 units. Now, someone do that math for me. 82.8 divided by 18. What number do you get in your... Say again? Exactly? Really? Let me see. We've got 82,800. We divide that by what? $18. Yeah, you get exactly 4,600? Okay, good. Okay, just wanted to check. Okay, all right, good. You come over then and you look at this one. And again, we want to make a profit, don't we? So what we do here is we simply add the target profit to our fixed expenses, right? Come up with the target profit units. So now we have this contribution margin of 98.80 per unit. Our fixed costs are 424. We set that up 90, then we have what? This target profit of 16,000, right? So you take the fixed cost of 424,840 plus what? Plus the target profit of 16. So now we have to generate enough units to cover what? A total of 440,840, which is what? Which is my fixed cost plus my target profit. So I set the thing up, contribution margin per unit, 98.80 times the target. Now it's target profit sales instead of break-even sales equals this 440,840. I divide each side by what? By my contribution margin per unit, 44840 divided by 98.80. And when you do that, what number do you get? What number do you get when you take the total of your fixed cost plus your target profit, which is 448.40, divide that by the contribution margin per unit of 98.80? What number do you get? 4,461.9. It's not cents, it's units. Times 0.94 of a unit. So what do? We always round up. Can you sell a 0.94 of a unit? No. You cannot. You can only sell full units, right? Now, what if the number would have been 4,462.1? You still round up because you can't what? You can't sell a 0.1 of a unit and you don't break even at 4,461. So for these problems, you always round up, right? Okay? Okay, good. And you come over and you take a look at, I don't know. This is kind of like, I should take these slides out of here. Well, you don't have to cross it out. There's nothing wrong with it, but it's like, what are we in the third grade? Okay, so, you know, if you graph this, here's my fixed cost, here's my variable cost. You graph what? You graph the sales line. In here, we're what? We're in a loss. We break even here, and here we're in the profit area. I think I've seen a couple CPA questions like that one time that asked where's the profit, and they, you know, labeled them somehow so that you had to know that that's where the profit was. But it's like, if you get a CPA exam question like that, what should you do? You should say, thank you, God, and answer it correctly and go on to the next one, because there ain't going to be many more easy ones like that. Okay, so, but I think you get that. Okay, good. Let's take a look at contribution margin ratio. To calculate the contribution margin ratio, we will take our contribution margin, divide it by our sales price, and that is going to give us our contribution margin ratio. That is telling what percent of each sales dollar does what? Goes towards my first fixed cost and then my profit. Now, the only reason you care about contribution margin ratio is that if you want to turn a break even in units to dollars, you have to take that extra step of doing what? Taking the sales price per unit and multiplying it by the number of break even units. Here, if you use the contribution margin ratio, the answer automatically comes out in what? Dollars for you, right? Because you're using that ratio which is being applied against the dollar amounts. You do not have to do it in total. If you like big numbers, that's fine. You guys like big numbers or little numbers? Big numbers, right? Especially when you're talking about your paycheck, right? But if you're talking about what? Calculations, you might say, well, actually I like little numbers that don't have to put in as many zeros, right? Okay, so you could do it on a per unit basis, which simply would have been what? Taking 200, dividing that by 500, that would have also given me the same answer, contribution margin ratio. Okay? Okay, so there's a couple different ways you can do it. In some problems, they won't give you the full sales. It'll just give you the what per unit, and you're going to have to know how to use the per unit amount, but it's the same thing, dividing the contribution margin by the sales. Okay? All right, so you come over and you take a look at this example that we were looking at before, and remember our contribution margin was what? $200 per unit times the break even in units, and that's set equal to the fixed cost. You do the algebra, you divide the contribution margin per unit times the fixed cost. My break even in units is 400, and if I want to turn that into what? Dollars, I have to multiply that by the sales price per unit. So I have to take that extra step. Okay. If I just wanted it in dollars right out, and I didn't want to have to take this extra step, I simply could have taken my fixed expenses, divided that by the contribution margin ratio, and that will give me what? Automatically turn that into a break-even sales dollar, right? Because the contribution margin ratio is telling you what percent of each sales dollar goes to cover fixed cost, right? And so you get the same answer here. I have to do what? I have to set it up. I always set it up. Break-even sales dollars times contribution margin ratio has to equal fixed cost. Do the algebra, and by using the contribution margin ratio, the answer automatically comes to me in dollars, right? Okay? Okay, good. So you come over, and if it's target profit, you can still use that contribution margin ratio for that. You just divide by the contribution margin ratio, and it's going to automatically give you the answer in dollars, which is sales dollars of $450 if we had a target profit of 100. Okay? All right, good. So let's take a look at a couple of those questions. MAC. Corporation's contribution margin ratio is 16%. Its fixed expenses are $44,000. If the company has sales of $299, what is the best estimate of the company's operating income? Well, if we take that $299 and we multiply it by the contribution margin ratio, that's telling us what percent of each dollar goes towards first my fixed expenses and then my profit, right? So if it's 16% of each dollar, I take the $299 times the 0.16, that gives me that $47,840 minus what? Minus the fixed expenses means I would have an operating profit of $38,840, right? That's 0.16 times 299,000. That's my contribution margin, which I got by taking my sales price times my contribution margin ratio, because that's telling me what percent of each dollar goes towards first. If each sales dollar first goes towards fixed cost, which we applied it first to fixed cost, and then what's the profit left over, which was what this question was asking. Okay? Okay, good. Let's take a look at this one, veterinary clinic, Garcia. And we have sales of 6, variable expenses of 120, fixed expenses of 300,000. We come up, this one made me come up with my contribution margin and contribution margin ratio using the larger numbers. So I just take the what? Sales minus the variable cost gives me contribution margin of 480,000. 480,000 divided by the sales price of 600,000 means I have a what? I have a 0.8 contribution margin ratio. I take that 0.8 contribution margin ratio, I set it up, times my break-even sales, what this question was asking, has to equal my fixed cost of 300,000. So I go ahead and I do the math on that, and that means that my sales dollars to break even is what? 375? Question? Every time I go through that question, there's like this look of skepticism on the class, like somehow we did magic up here. Break even is what? 375. Now this company's more than breaking even, aren't they? At sales of 600,000. But we can still use that relationship between sales and contribution margin to come up with the contribution margin ratio. And once we have that, assuming we know the fixed expense number, we can calculate the break-even sales dollars, right? Okay. Okay, good. Let's take a look at this one. And here, I could have done it with the big numbers. I could have done it with the little numbers. When it comes to calculations, I like little numbers. So 20 minus 12 is 8. My contribution margin per unit is 8. I divide that 8 by the sales price per unit, that 20. That gives me a contribution margin ratio of 0.4. Okay. Now they say, what is the amount of contribution margin if sales volume increases by 30%? So you first have to get the increased sales, right? And the way you get that is by taking the 300,000 and multiplying that by 1.3. The 1 takes care of the what? 100%. The 0.3 takes care of the 30% increase, doesn't it? Hello? You sure? Okay. Sometimes I get students who are like, go away. Oh, hang on a minute. We're good? Okay. So I have 390,000 of sales if I increase 30%. And so I take my contribution margin ratio of 0.4. And so if my sales increase 30%, my contribution margin will go up to 156. Sometimes I get students that want to take the 120 and multiply that by 1.3. That won't work. That will not work because what's happening, you're not accounting for the increase in variable costs that go along. I'm not increasing variable costs, but the increase in your total, not per unit, but you're increasing your total variable cost that goes along with that increase in sales. Can't do it that way. Okay. Okay, good. I think I wanted to get rid of this slide. I don't need this slide. Okay, so let's go ahead and let's take a look here now and see. Oh, I see why I put that slide there. Now I remember. What some of these, one of the major takeaways of some of these analysis that we're going to be doing is understanding how the contribution income statement format will help you to answer many of the questions that are coming up on the next slide. Analysis, quick analysis that you may want to do, and you don't want to sit there and have to dig through the financial statements every time and figure out the fixed cost versus the variable cost. You just have your financial statements set up like this so you can do a lot of these analysis that they're about to do on some of the next slides. Okay, so we have these people talking, and when I look at this, does he want to be there? I'm thinking, why did she put her briefcase down and he's still hanging on to his? Well, I don't know. Now I got to listen to all her crazy ideas again, right? Okay. Well, at least she has some ideas, right? He's sitting there wanting to figure out what the time lunch is, right? Okay. So let's go ahead. But the point here is what? You can have these sort of quick conversations, decisions about, different things, not decisions, but at least conversations about different things, and ultimately decisions by using that contribution format to the financial statements. So here they're suggesting that what? Increase unit sales from 500 to 540 by increasing the monthly advertising budget by 10,000. Now, is advertising a fixed cost? Really? It changes by the number of units? So if I sell more units, my advertising goes up? No, so it's pretty much a fixed cost, right? So we want to see, hey, once we know what our contribution margin is, we can start to play with different scenarios to see how it's going to affect my contribution margin. And if it affects my fixed cost, I'll see if I'm going to make more money off of this option versus the current status. Okay, so I come over and they set this up in the contribution format, okay, and they take the 500 times now 540 bikes instead of, is it 40 more bikes they're going to sell? Yeah, it's right there. Hello, John. It's right there. 540 bikes. They take the what? $300 times the 540 bikes for my variable expenses, give me a contribution margin of 108. And if I increase my advertising by 10,000, my fixed costs go from 80 to 90. Was this a good idea? This was not a good idea. And you're quickly able to figure that out, right? Okay, in this format. Now, sometimes you may not even have to go into the full format if it's something where just one variable is changing, or I guess that was two variables. My contribution margin is changing, my fixed costs are changing. It could be pretty easy to just say, well, look, I have a contribution margin per unit of $200. I'm going to sell 40 more units in this example. That's going to generate 8,000 more contribution margin. But if my fixed costs go up by 10, I'm losing what? 2, right? So some items you could sort of do them like this, quick and dirty, without having to prepare the full contribution income statement format. Other times you may want to just go ahead and do the full statement, okay? Which is basically what we're going to do here, because now we're going to use higher quality raw materials, which is going to increase our variable cost $10 per unit. And we think that if we do that, that will increase our sales by what? 80 units, from 500 to 80. So now I'm going to go ahead and just pull out the full contribution format to look at this one, and it's what? It's 580 bikes now times 500 would generate revenue of 290. It's what? It's 580 times, now the variable cost went from 300 to 310, so that's going to give me 179,800, and then I go ahead and I have a contribution margin here of 110,200. There was no discussion of adding advertising or anything like that to affect my fixed expenses. And so this company did what? They did pretty good. They're going to see an increase of 10,200, right? Okay. Okay, good. Let's take a look at another scenario. Company cuts its selling price by $20 per unit, bike company. Increase in advertising 15,000, and they think if they do all this, that will increase the sales from 500 to 650. So you go ahead, now we have 650 units times, and now it's 480 per bike, not 500. Variable expenses is going to be 650 times 300, gives me contribution margin. More advertising, more fixed expenses, that's 15,000 more. And then what? And then we go ahead and we see that we've got $22,000 more in net income, right? Now, do you want to do this? You want to do this option? You do, because what? It increased my income 2,000. Is this going to happen for sure? No doubt. No matter what, I'll be able to sell these many bikes. So, you start looking at the increase, but you got to weigh it against the potential that will actually happen. In textbooks, they'll say, yeah, you should automatically do it, right? But there's not a guarantee that all this is going to happen. Who knows? Maybe I can't sell them 650 bikes. And if that's the case, then I'm stuck with a bunch of extra bikes, right? And less profit than I had before. So you could add to this, what? Probability analysis. You could sit there and say, a 10% chance of this happening, 40% chance of that, and so on, and use a probability-based approach so that you're a little more certain, have a little more certainty that the results are going to turn out in line with what the probability analysis is telling you, right? Okay? We won't get into probability analysis in here. I just want you to understand that that's something that would also be considered here, right? Okay, good. Now let's say RBC has an opportunity to sell 150 bikes to a wholesaler without distributing, sounds like a wholesaler instead of a half a sailor, okay, to a wholesaler without distributing sales to other customers or fixed expenses. Okay? Now it says, what price would it quote to the wholesaler if it wants to increase monthly profits by $3,000? So what's happening here? Have we already covered our fixed costs? It says it won't affect fixed expenses. We're assuming we've already covered that then, right? So we're covered on our fixed costs. And this person wants to come in and order 150 bikes. And we're thinking, okay, great. We've already covered our fixed costs. We've already made our target profit. We have what? Excess factory capacity. If our factory capacity was at full, we'd have to sit here and analyze, well, are we going to throw some business out the door over this guy or what? But since we have excess capacity, we only have to think about what? The option of adding these 300 bikes. Or not 300, but what? 150 bikes to give us $3,000 extra profit. Okay? Now you take that $3,000 extra profit, you divide it by the 150 bikes. That means we need $20 per bike. Okay? And if our variable costs are what? $300 per bike, then we have to sell the bikes for $320, right? So that we'll have $20 left over. And since we've already covered our fixed costs, assuming we're happy with our profit as it's been already, then we can go ahead and sell the bikes for $320. And if we do that, we will accomplish the goal of increasing our operating income by $3,000, right? What's wrong with this? What's a potential problem with this? Potential problem. How much were we selling our bikes for before? No, we sold 150 bikes. How much were we selling our bikes for earlier in these problems? In this example, 500, right? Now we've come down to 320. So, this guy goes to the bikers conference with, some other person that's paying 500 and says, oh yeah, I got a bunch of bikes from Lord for 150 and I only had to pay 320 for them. It was great. The other guy goes, he charged me 500 per bike. So he's going to come back to me and say, no, I'm not paying you 500 per bike anymore because I know you're letting them go for 320. What do I say to him? What do I say? Huh? Well, that sound you hear is me not breaking even anymore because we have a certain level of sales. It was all contemplated on 500 per bike, right? I start selling for 320. That makes a contribution margin of 20 bikes, $20 per bike. I'm going to have to sell 52,000 bikes. No, I don't know how many bikes, but that contribution margin has come way down, right? In fact, I don't know if the math would work. I'd have to sell 10 times the number of bikes, right? Because my contribution margin was 200. I was willing to accept a contribution margin essentially of $20 per bike here, right? Because I'd already covered my fixed costs. So what do I tell the guy? I start telling my receptionist, when so-and-so calls, don't tell him I'm not here. What do I do when he calls? Well, you're kind of on the right track. I say, go ahead, be the person that's calling. You can be the person that's calling saying, hey, how come you sold it from 320, you sold it for me for 500? Don't you like me anymore? No. No, you're the person calling complaining because I have the answer. Okay, go ahead.
I'm not a good...
You're not an actor? That's why you decided to get into accounting? Okay. Okay, who wants to be the person calling you? Come on, there's got to be someone that wants to step into that role. Didn't they have you do acting in high school or something? Okay, go ahead. Okay. Excuse me. What's going on?
I don't want to be paying 500 for a bike loan.
Why? What happened?
Someone else is paying less than me.
Who? I don't know who. I've got a lot of customers. Give me a name. Frankie Frankston. Okay, hang on a minute. Or whatever. Click on the computer. Well, wait a minute. What's your name? Huh? Rhea, you bought 12 bikes from us. Frankie bought 150 bikes. Would you like to buy some more bikes? Because it's my understanding that you go over to Betty's bike shop and you're buying bikes from her, and she's charging you $480 per bike. I can beat her. How many bikes are you buying from her? Yeah, well, stop doing that. She's ripping you off. You come over and you start buying bikes from me, and I would, again, have to do some sort of analysis, because now, it's affecting my current business, right? So I wouldn't just jump out at 320, but I can start to make the point of this, a little more of the story. Thank you, Ray, for playing along. The moral of this little play act, whatever, is what? That you're sitting there, and by setting up your financial reports like this, you can start to what? Make those kind of decisions, help you in the negotiation, that kind of thing, right? Okay. Now, as I told you, I'm teaching an introductory financial managerial class at Stanford, and I had one of the future entrepreneurs, whatever. See, every time you say that, people clap. Yes. One of the future entrepreneurs comes up to me and says, "Well, how would I determine what my my factory capacity is?" Did I have an answer for him? I mean, I don't know. That's a what? That's an engineering estimate, right? And then he says, "Well, how do I know how much I can sell the bikes for?" That's a what? That's a marketing. So you've got a marketing person. You've got what? You've got a person there that is a operations person, and we take the numbers together and we can prepare this contribution margin format financial reports, right? We could also sit there, and when they put together like a prospectus, like you're trying to get seed money and you're going through these different series of issuing stock and all that kind of stuff, the other thing you could do is project out, right? So you can go ahead and project out, well, if sales increase this much, this is what will happen to our operating income. If sales increase this much, this will happen to contribution to our operating income, our contribution margin, and sometimes what? Potential investors will want to see the financial reports in this contribution format so they can kind of see how that operating income starts to blow up after certain numbers of units, right? Then they can sit there and they can say, well, how do we know that those marketing estimates are reliable? So what would you do then? Probably provide them some information as to the evidence that was provided there, but you could also get in there an accountant, a CPA. Any CPAs in here? Okay, me. Okay, you can get me to come in there and take a look and say, okay, I've looked at your projections. You've given me evidence to support your projections, and those seem reasonable based on the facts, whatever. And then there's a third-party reliability that's added to that as well, right? Okay, so even though we're talking that these are for internal decisions like this, might help you with the negotiations, that kind of thing, there could also still be a component where you're looking at external users that might be interested in seeing some information like this as well. Okay, good. So you come over, and we have this thing called the variable expense ratio. Okay, and this is sort of like an annoying thing, in that if I give you the variable expense ratio, can you come up with the contribution margin ratio? You simply take 1 minus whatever the variable expense ratio is, and that'll give you the contribution margin ratio, right? Okay, and then you can go from there the way we have in some of these other problems. So you take a look, and we have this problem where they gave me the variable expense ratio. 1 minus 35% equals what? 0.65. And if we wanted to know what our operating income will be if we have sales of $75,000, or if sales increase 75,000, what would be the increase in our net operating income? 0.65, and I guess there was going to be any change in fixed cost here. Oh yeah, they have an advertising campaign. It will be 25,000. So we're just looking at the margin here now, aren't we? Okay, for the increase. And so you have this 0.65 times the 75,000 increase in sales minus my increase in fixed cost means with a contribution margin ratio of 0.65, I would have an increase in operating income of 23,750. Okay, question? Okay, let's look at how contribution margin ratio could help you, or contribution margin analysis could help you to run your business a little bit more profitable, okay? And one example here is dealing with sales commissions. Sales commissions are often quoted on the sales price, right? You ever sell a house, the real estate person will come in and they'll say, okay, you know, you got to pay me a 5% commission, and that's on the what? Sales price. So every time you want to figure out, you know, how much money you're going to get off the sale of your house, whatever, you always have to take the sales price and divide it by 0.95 to get the, multiply it by 0.95 to get the actual cash that you're going to get out of this deal, okay? Because you have to give 5% off to the salesperson, okay? Well, if we're running our company and we set our sales commission on sales price, we're going to be motivating our salespeople to sell the item with the higher sales price, right? Because they get a better commission. Meanwhile, the item with the higher sales price could have a what? Theoretically have a smaller contribution margin. So we've set up a sales commission approach that is what? Motivating the salesperson to do things that are not in the best interest of the company, right? Which is sell that more costly or more expensive product that has a lower contribution margin ratio. So if you look at this one now, you got exactly today. Okay, you can come over here and get to be like Buddha sitting here talking about counseling, right? You got the body shape, the head, everything. So what happens? Pipeline Unlimited produces two types of surfboards, the XR7 and the Turbo. The RX7 sells for 100 and generates a contribution margin of 25. The Turbo sells for 150 and earns a contribution margin of 18. Now, if you're the salesperson, you want to sell what? You want to sell this one, don't you? Because you can get $15 commission. It's 10%. I think I made the 10% up. If the commission is 10%, you're going to get $15 versus $10 for the cheaper bike, right? Meanwhile, the cheaper bike has a higher contribution margin, right? So what would you do if you were running this company? Would you tell your salespeople, hey, sell the one that sells for 100. You take a smaller salary home. Don't buy your kids any presents this week. Is that what you do? Become real, like, you know, you like working here, don't you? Then go and sell the cheaper bike. Is that how you handle it? I told you to stop selling that expensive bike. What would you do? Set a quota. Again, forcing them. Sell so many of the cheaper bike and take less money home. And I don't want to hear it anymore. Now get back in there. And by the way, wash my car when you're done. Huh? Why don't you, as this book suggests here, set up the commission on the contribution margin? So give them a percentage of contribution margin. Now they're like, oh, okay, I get it. Forget the 150 bike. I want to sell the $100 bike, right? Now you can use this as a consumer. You ever been in a store and they start trying to sell you something that you know is cheaper? It's not as good. It's $100. It's $100 and it's not as good. You're like, I don't want the $100 one. I like this one. Yeah, but if you really turn the pedals fast enough, they might fall off. And they start coming up with all these reasons as to why you shouldn't buy the more expensive thing. Maybe what? Maybe they're sitting there and they've been told that one has a higher contribution margin to the. Right? So now you're the salesperson's nightmare. You walk in there and you say, well, which one has a higher contribution margin? That's what I want. Okay? All right, good. You want to go through some more questions from the file, or you want to go home? Okay, that's fine. Okay, look at the rest of the questions that are in that quiz. I'm not going to go through those unless there's specific questions next time. You'll see the questions. There's only like maybe 5 that are left in the quiz. And next time, we will jump into Chapter 6. So Monday, we hit the ground running with Chapter 6. We start talking about variables versus absorption costing. Okay? All right, guys, I'll see you on Monday.